Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool and one of the founding members of the Dividend Kings marketplace service on Seeking Alpha. This is one of my subscriber request series for our YouTube channel. I've actually had several people ask me to review Pfizer. Of course, Pfizer is one of the major pharmaceutical companies in the world. It's got over $190 billion market cap, a total enterprise value of over $237 billion. It's AA- rated and only 31% debt. And it's a company in transition, which I talked about in the written portion. They're offloading their legacy products, a lot of them that are coming off patent. The company is really moving towards streamlining their business. They don't have to worry about patents, expiring anymore. They've got a big new pipeline of drugs that I do want to give you at least a quick look at before I get into the actual fast graph analyze out loud video. They've got 26 drugs in phase 1, 37 in phase 2, 23 in phase 3, and 9 in registration for a total of 25. Now that I've kind of gone over that, you can see the company's future looks pretty exciting, especially since they won't have the drag of, a lot of their existing drugs coming off patent. They offloaded those to Mylan Labs, the old Upjohn products. But I also want to point out some things about Pfizer as a business and what it's been. It's a company in transition, but it's been a company in transition. First of all, prior to 2004, it was a very powerful growth company. I can't go back any further than that, but its growth rates were very, very high. It was, in the 15 to 20% plus range for many, many years. In fact, coming into what was called the irrational exuberant period, June of 2000, you can see the stock was trading at a PE of 52 and was clearly excessively overvalued, even relative to the strong earnings growth that the company was achieving during that time. But what I want you to notice is subsequent to that time, in fact, if I go ahead and scroll off some of these years here, I want you to notice, if I use my scroll bar here, if you look at what Pfizer's done more recently, earnings growth has been actually very anemic. It's only averaged about 2.87%. So the company is a major, pharmaceutical company, and it's actually moving, as I showed you in the first slide here that I showed you on the company on their website. It's really moving into a biopharmaceutical posturing. But the point is the company's earnings growth rate that went from these 21, 10%, 21% growth rates has slowed down to these very slow growth rates in subsequent years. So the growth rate here is 6.5. If I scroll out these years like I did, it drops down to under 3%. So it's been a very flat grower, and you can see performance hasn't really been that great. Now, like all stocks in the Great Recession, it fell dramatically. They even cut their dividend during the Great Recession from $1.28 to 66 cents. However, if I shorten the time frame and look post-recession, the company's growth has been a little better, 4.38%. The stock was very undervalued in December of 2009. And if I look at performance over this time frame, you could see that they generated a significant amount of dividends, outproduced the S&P by almost double on dividends. However, they lagged the S&P on capital appreciation and total return, but they still end up giving us almost a 9.5 or 10% total return. Now, that was functionally related to the fact that even though they were undervalued, they didn't really grow that much. If I chop this off another few years off of this graph, you can see that, the stock was trading at around a 15 PE ratio, which is what the multiple of this orange line is, trading between a 14, which is the blue line, and a 15 PE ratio since 2013. Now, as I mentioned, the company's in transition, and what that means is the earnings are expected to be down. The consensus estimates are for earnings to be down, operating or adjusted earnings to be down 7% in fiscal year 2020, which does end in December. But then I do want you to notice the analysts are expecting double-digit accelerated growth going forward for the next 3 years or so, at least for the next 2 years for sure. So on the basis of this accelerated growth as this new, leaner, smaller, more streamlined company after they divest their legacy products are going to give them the opportunity to grow. So rates of return going out, and I'm not going to go out any further than 2022 here, which is still pretty far. You could still expect to make almost 20% annualized rates of return. The numbers are better, over 20% through 2021, and that's after a lackluster year this year, followed by a really strong year going forward after that. So Pfizer is a company in transition, and I think you ought to be considering that when you're looking at the stock. It's significantly undervalued, trades at a blended PE of 11.89, which is really attractive. perspective, has a 4.38% dividend yield. And I do want to show you, I do want to go back to the performance for a minute. If you look at its dividend growth rate since 2010, it's averaged over 8% a year, both on an average and a compound average growth rate, 8.3% to be precise. I would anticipate that we might see a faster or an acceleration in growth over the next 3 years once we get past 2020, which again is because it's a transition year, there's going to be a little bit of downward pressure on earnings this year. A couple of other metrics I want to look at very quickly on the company. Let's take a look at Warren Buffett's favorite owner's earnings. Again, we expect a down year this year followed by some great strength. Now this includes maintenance CapEx investment. That's why Warren Buffett likes it. From a forecasting point of view, we once again see very strong expectations going out beyond 2020. We see a negative 2% growth this year on owner's earnings, which is a little better than I showed you on operating earnings, followed by 26% and 15% going forward. Now, dividends are a big part of the allure here. You've got a 4.38% current yield. And if I look at dividend yield historically, it's been a stock that has generated relatively high dividend yields for most of the past 13 years or so, which has been its attraction, but it was a low growth stock. When now we've got a transition where if we buy it today while the valuation is low, we can still look for significant current yield of over 4% starting out. But as I mentioned earlier, I think we could expect some faster growth going forward. So it's kind of a very intriguing stock. I am long this stock. For disclosure purposes, I do have it invested in my dividend income portfolios that I manage for other people. I consider it very attractive right now. I originally purchased it back here in 2017. It's basically as attractive today as it was when I originally purchased it the first time. When I'm looking at operating cash flow, you can see the stock is also trading in line with its normal operating cash flow multiples that the market has applied. But what I really like here is operating cash flow significantly covers the dividend, and I think that's critically important. Now, I also want to go back to earnings. So, covering the dividend. Now, I've got free cash flow here also I want to show you. I don't have forecasts for this year's free cash flow. I'll tell you that in advance. But historically, at least going back for the last 13 years or so, which is, the period since coming out of the Great Recession, if you will, the company's free cash flow, let's get rid of price here, free cash flow has significantly covered the dividend. So I consider that a big plus for the company. Going back to operating earnings for a moment, I also want you to notice something else. If I look at the years 2013, 14, and so on, 15, 16, the stock has been reasonably or very attractively valued during this whole time frame. And that's important because if I go into my fund graphs, which is financial underlying numbers that Fast Graphs produce, I want you to notice that since 2009, the company has reduced their share count by 2.1%. So in addition to paying a nice dividend, the company's also been rewarding shareholders through share buyback. So all in all, I do believe this is a very attractive opportunity that investors can take advantage of now. From an earnings perspective, the stock is significantly undervalued, has great upside, has a good dividend yield, it's AA- rated, has very minimal debt. So this is one that I think you might want to take a closer look at. I would do your due diligence. I do believe that you need to get a little bit more knowledgeable about what the company's doing with the actual transition of moving out of the Upjohn products, their legacy products, and looking to deliver. This is Morningstar here. They've divested their drug platform Upjohn. The remaining part of Pfizer should be positioned for stronger growth according to Morningstar. They do give this company a wide moat. So, because of patents, economies of scale, as I mentioned in the article, and a powerful distribution network, Morningstar awards Pfizer a wide moat. So I think this is a very intriguing company, one that you might want to take a closer look at. Anyway, this has been Chuck Carnevale saying thanks for watching the video. This is one of our subscriber request series. I've had many subscribers ask me to look at this particular company, and I was delighted to do so. So here's Pfizer. Do your own due diligence, but the stock does look very attractive today. And if you like what you saw here, please don't forget to subscribe to our YouTube channel because we got a lot more videos like this to come. Thanks again. Talk to you soon.